This segment is sponsored by RVA Wealth Management.
Our next guest is here to answer some common questions you might have right now when it comes to finances. We welcome David Koren of RVA Wealth Management back to Virginia this morning. Always good to see you, David.
Good to see you too, Bill.
So I was thinking about when I was a young man, I had a button that said WIN, win, and it stood for whip inflation now. And that was absolutely the last time I thought about inflation. But apparently we need to think about it now and how it's going to affect us.
Well, yeah, I mean, for the last 20 years or so, inflation has been very tame, below 2%. I think the average is about 2%. So we haven't seen the double-digit inflations, which you are hearkening back to, of the 70s and 80s, in a really long time. But we do know it can happen. And there's a great deal of concern now that the recent activities by the federal government to combat the coronavirus, that would be both the Fed and the government with all of their stimulus bills, that inflation is going to come back. And the Fed has also made it very clear that they want inflation to come back. They want to get back to an average inflation rate of 2%. So they are willing to let the economy run hot or inflation go up higher to allow that to happen, to get back to that average rate of 2%. And we do think that given all the money that's in the system, given the fact that we're hopefully going to come out of this pandemic later this year, there's a lot of pent-up demand out there in the marketplace for doing things that we haven't been able to do. You know, festivals, carnivals, going out, the theater, ballet, et cetera, all the things that have been prohibited for so long. That's going to create a lot of demand for services. Jobs are going to heat up. The wages are going to go up, along with we're already seeing inflation in a lot of areas. So our belief is that, yes, we will see inflation get above 2%. And we need to be ready for that. And to be ready for that, that means that you need to be invested in a position to deal with it. And this would be equities, commodities, real estate. These are all investments that have done well against inflation in the past.
All right, so we got a plan for it because it definitely is coming down the pike at some point. All right, David, you live in a world different from mine because you're about finances all the time. And when this GameStop thing happened recently, people asked me about it, and I went, I don't understand it. What are we going to invest in next? Blockbuster? I mean, it didn't make any sense at all to me. But it's what I've been able to figure out, it kind of was like everybody was just betting, weren't they?
Well, in a sense, yes. The GameStop phenomenon represents a very small part of the market, obviously, but the Reddit folks basically declared war on the hedge funds, and we don't like to be involved in wars, so we don't want to go there. But there's always been this opportunity in the marketplace to do what we call forcing a short squeeze on heavily shorted small cap stocks like GameStop was. You just need enough investment on the opposite side of the trade going long to make it happen. And that's by banding together, the group at Reddit was able to accomplish this. They actually did this on not just GameStop, but several other stocks. And they cost the hedge funds billions of dollars, $70, $80 billion, I think, were lost by some of the hedge funds in these trades. And in the future, it could lead to fewer short trades in the market. But as far as we're concerned, it's not a bubble. It's not a sign of a bubble. It's just a new way to exploit the short squeeze. It's a lot like gambling. It's very high risk, as you said, and we would advise against it. We're investors, not traders, and this is definitely one of those risky trades.
All right. So I'm looking at all of that and all of the stuff that happened around it, and I'm wondering how are we going to protect our retirement funds from all this volatility that's going on.
Well, and we work with our clients in retirement to make sure that they have the money they need to cover their living expenses and to be able to maintain their standard of living. I'm going to be teaching a class starting actually this month, and we are going to cover this very complex question in a great deal of detail. We really like to look at the client's cash flow and how much principal do they need to keep in safe investments like cash, short-term bonds, what's their dividend flow, what's their interest flow that's going to be needed to cover their withdrawals over a long period of time. And if we can accurately calculate this need, then it gives us a lot of time to allow the market to recover from any downturn. And it allows us to sleep at night, quite honestly. It allows our clients to sleep at night, knowing that the growth side of their investment strategy has a long window to recover from any kind of downturn that may occur out there. It's complex. It's different for each client because each client has different risk profiles and different income needs, obviously, in retirement. But as long as the portion of the portfolio that we've assigned to growth is not needed for income in the near term, it gives us a lot of peace of mind.
David, always good advice and always gives us something to think about. Thank you, sir. Appreciate the help.
All righty. Take care, Bill. Good talking to you this morning.
For more information about RVA Wealth Management, visit rvawealthmanagement.com. You can call them at 804-497-2100. Stay with us. Virginia This Morning returns after a quick break.